Okay, so let's get started. Today's July 15th, 2019. This is Bruce Connors from BlueKey Advisors and Envision Asset Management. And the title of today's webinar is Don't Fight the Fed. Fed has been the main topic the last couple of weeks as the market has gone up pretty much every day. And Fed Chair Jerome Powell made it pretty clear that he's going to cut interest rates at the end of July. So today we're going to go over Q2, look at some economic indicators, valuation measures, and then take a look going forward. So here's the market since about the middle of 2016, and green area that I just shaded, that was right after Trump's election. We had a big rally focused on less regulation, corporate tax reform, tax cuts, synchronized global growth around the world. As we got into 2018, Trump started talking about tariffs and trade war. Before that, everyone had kind of thought that that was really all campaign talk. He wouldn't be serious about launching trade wars. They're too dangerous. But he went ahead and started putting tariffs on China, increasing the chances of a trade war. That hurt growth around the world. There was a divergence between U.S. stocks and international stocks. So for most of that time, we were sideways, and then the U.S. rallied while international stocks were pulling back. Eventually, all the trade war talk, as well as the possibility of higher interest rates, led to worries about a U.S. recession. We had about a 20% sell-off that ran through December 24th. That's when the bottom was hit. And then since then, we've pretty much been in rally mode. The Fed did basically a 180 pivot from talking about increasing rates to not increasing rates to now cutting rates. They've also spoken about stopping the unwind of the balance sheet, and that's why the markets have really rallied recently. There's also hope that U.S. and China will agree to some kind of trade deal, or at least things won't get worse from here. The other thing that's really helping equities is it's not only the Fed that has been a big positive to markets, but around the world, central banks everywhere have taken a much more dovish tone. And right now we have a record of over $13 trillion in negative yielding debt. So governments basically are lending money around the world outside the United States to the tune of greater than $13 trillion. Plus, at this time, there's greater than $26 trillion in debt around the world that's yielding less than the inflation rate. So really, investors are being pushed into riskier investment products, and that includes, for the most part, equities. And that has led to this big rally. One of the things that is pretty unusual with the Fed possibly cutting interest rates at the end of the month is that, based on traditional measures, there's not really need for an interest rate cut at this time. In other words, the economy is not in a recession. There is no liquidity crisis with getting money. Inflation is not taking off. So this would be considered unusual to cut rates in this environment. However, it has happened at least two other times that I can think of in the past century where the Fed did cut interest rates when the economy was doing pretty decent. And in both cases, it was in response to international concerns. And that's one of the reasons that Powell has cited on why he's going to cut rates at the end of this month, worries about a spillover effect from a slowing global economy. The last time was in 1998, and that was in response to the Asian financial crisis, the Russian debt default, and the collapse of long-term capital. However, at that time, the U.S. economy was doing pretty good, kind of like it is now. Inflation was low, and markets were liquid. So the Fed set off, and you'll see over here in the ABC, they cut rates 3 times during that period, and that really set up a big market run that went to about 2000. And of course, after that, we had a huge sell-off of about 50% or so, going into 2001 and 2002. The other time was back in 1924, and at that time the New York Fed effectively was the Federal Reserve, and Ben Strong cut rates in May, June, and August of 1924, and it's showed right here in the ABC. And the reason he did that is not because the U.S. economy needed it, but he wanted to help out Britain. Idea was that if rates were cut, that would attract more gold back into Great Britain. And that's what happened. And as you see, that set off a period of a lot of speculation, which led to the big run up. And after that, combined with the Smoot-Hawley tariff, that led to the Great Depression. So I'm not saying that that's going to happen here, but in both cases, after the Fed cut rates at a time when the economy was at least growing at least in slow growth mode, it led to big rallies. That's why we're saying now, don't fight that. So time will tell if we get a repeat of what happened in the past and we get these significant rallies. But for now, that's always been an old adage, don't fight the Fed, and that appears to be what's been driving the markets over the last few weeks. Back in December, we showed this chart minus the bottom line right here, and we looked at periods when there was a huge sell-off over 14 days of greater than 15%. And that's what happened up to December 24th. We had almost a 16% sell-off, and we said what happens 1 month, 3 months, 6 months, and 1 year later, and pretty much in most every case you had a really nice rally, and that's what's happened since this December 24th of 2018. So we'll follow this up in December of this year and see where we're at. But history has pretty much stayed on the same course and followed the same path as the previous times when there was a big sell-off over a very short-term period. Let's see how we did in the second quarter. And these are by style boxes. So mid-cap growth was the top performer. In sectors, financials, and then technology with leaders. International frontier markets, plus 7.3%. And in fixed income, the long treasury bond was the big winner at plus 5.6%. What's going to happen from here? There's starting to be many indicators that are now leaning towards the thought that there'll be a recession a year from now, or 18 months from now, maybe 2 years from now, maybe a little bit less than that. One of the reasons that Powell wants to cut is he wants to get in front of that and see if he can head off the possibility of a future recession. So that's another one of the reasons he wants to cut rates now, and time will tell if that helps or not. Here you're looking at the leading economic indicator by the Conference Board. That's the blue line. You'll see how it has started to flatten out. And the red line is the coincident index. And usually when the gap between those two begins to narrow, that's a leading indicator for a recession. So for now, and you'll see over here in the bottom right, it has begun to narrow, not by a lot, just by a little, but it might be an indicator of something to come, so we'll keep an eye on it. The Treasury spread, this is the difference between the 10-year bond and the 3-month Treasury bill, has been inverted. We're at less than zero. The red line is the zero line. And in the past, that's been a good indicator of a recession coming up. But this is a calculation done by the New York Fed of the probability of a recession, and it looks at the 10-year and the 3-month for their calculation. It goes out 12 months. That's why it says June 2020 here, and it's now up to 33%. We've been tracking this as we've been doing these webinars, and you'll see how it's gotten higher and higher and higher as time has gone on. This red line here I put in, and that's when it's gotten above 30%. And you'll see it's been a pretty good indicator of a future recession. Initial claims for unemployment, this is the 4-week average. This is as of July 7th, and it has flattened out. Normally this will be turning up a little bit before a recession. But for now, we're really at historically low numbers in terms of initial claims for unemployment insurance. You'll see this dates back to the 1970s. It really hasn't been so low in a very long period of time. The employment market still looks pretty good. U.S. light vehicle sales, they have been pretty steady for a while now, so they haven't turned down as normally happens before a recession. This is the ISM Purchasing Managers Index. Any reading above 50 is considered expansionary, below 50 is contractionary. You'll see how that has turned down a lot over the last several months. We're still above 50, but it seems to be declining fast. And in periods when it has declined, that is a leading indicator for recessions somewhere down the road. By the way, on all these graphs, the darker shaded area indicates a past recession. Heavy-duty truck shipments, they're holding in there. They have not declined yet. So for now, this indicator is neutral. The high-yield spread also has not turned up as normally happens before a recession. It did turn up a few months ago, but it's way back down now to 4%. And a lot of that is due to the dovish stance of the Fed and lower yielding rates around the world. People are just looking to invest in riskier securities to get some kind of yield. This is the estimate for Q2 growth by the Atlanta Fed. This is the GDP now. It's at plus 1.3%. So you'll see Q1 2019 was 3.1. So this is for the Q2 estimate 1.3. It would be much lower than we've seen in the recent past, and again would indicate a slower growing economy. Here's the Purchasing Managers Index from around the world, and these are roughly every 3 months. We record the numbers, and you'll see how this entire chart has gone from greenish to more yellowish to reddish as time has gone on. So readings less than 50 again are contractionary, and right now there are over 10 countries below 50. And last time we did this, it was 6. It was 6 the time before, 0 before that, 3, 1. So the trend is definitely towards slower growth. Here's the 10-year Treasury rate, and it's dropped down to 2.04%. Here's a chart of the assets that the Federal Reserve holds versus the S&P 500. The Fed assets are in purple. The S&P 500 price level is in orange, and we're showing percentage increases. And you'll see there's a pretty good correlation that as Fed assets go up, the S&P 500 has gone up. And in the rectangular box I just put on the screen, you'll see that when the unwind started, when the Fed started selling off their assets, the S&P 500 pretty much went sideways to down for most of that period, and then started to rally when it became clear that the Fed was soon going to end their unwind and that they were going to become dovish in terms of their interest rate policy. So the market is back in rally mode. But when it was in sell-off mode, when the Fed was selling off their assets, the markets went sideways to down for much of that period. Here we're taking a look at sell-offs greater than 5%. We've been tracking this since 2005, and we did have one sell-off this year between April and June. It lasted 35 days. It was a 6.57% sell-off. And again, that is in line with market history. You'll see here how many sell-offs we had, between 5 and 10%. It's not unusual to have that, and to have greater than, this should be a greater than 10, less than 20%. It happens every couple of years or so, and then greater than 20% would be considered a bear market. In 2018, the SPY just got over the 20% sell-off mark, whereas the official S&P 500 was just under the 20%. So that's why we have greater than 20% here, because these numbers are based on the SPY, the S&P 500 ETF. This here is showing the annual drawdowns, the max drawdown for the SPX, that's the S&P 500, since about 1970. We just want to show here that it's not unusual. Markets don't go up all the time. You often have sell-offs during the course of the year, and that's part of being an equity investor. So investors need to understand that. Let's look at some valuation measures. This is the Shiller PE. The Shiller PE does a calculation of the current price divided by the average of the 10-year earnings adjusted for inflation, and we're really at close to historical highs. The PE is 30.9 as of now, and that would be considered in the 82nd percentile at this point. The historical mean is 17, and this calculation, which is done by GuruFocus.com, calculates an implied future annual return of negative 2.2% for the S&P 500. So based on this metric, and this metric has been wrong for many years, it's been high for a while, but based on this metric, the next 10 years or so, it might be hard to generate good returns in U.S. equities. This is a chart that we keep, and this was as of July 5th. The price was $29.90. We're now north of 3,000. But the PE ratio as of that date was 18.03, based on calendar year earnings estimates for 2019 of about $166. Since then, the market's gone up a little, so this number's a little higher. But you'll see 18.03 compares to a PE of 16.5 since 2004. Here is the 10-year Treasury bond minus the S&P 500 yield, and on this chart, if the bars are higher, that would indicate that the yield on the 10-year treasuries is greater than S&P 500 yield. So if treasury bonds are yielding more, that would be competition for equities and would be a reason for some equity investors that are more conservative to switch into bonds or Treasury bonds. And you'll see how this has gone down over the last, basically since December, it's gone down by a lot, and there's only a differential of 13 basis points now. Again, indicating that stocks are becoming a better value than they were back in January. Here's the Morningstar median fair value, and here the ratio is 1.00. 1.00 indicates that the median stock in the Morningstar universe is fairly valued. And you'll see we're getting closer to jumping back into an overvaluation. We look at Value Line, and this is their appreciation potential over the next 3 to 5 years of the stocks that they rate. And you'll see how the appreciation potential has dropped to 50%, and it was as high as 65% back in January. So as stocks have gone up, the potential future return has declined. Here's the PE ratio, looking at it by decade, and the orange line is the current decade, and you'll see how it's generally been higher than most of the other recent decades, and the reason for that is that interest rates have been lower. So again, here's the PE ratio. You have higher PE ratios, and down here you'll see that we've had historically low interest rates during that period. So low interest rates is going to increase the value, the present value of future cash flows, and that would increase the value of equities. So let's talk about where the market might go from here. Of course, nobody knows for sure, but here are some of the reasons why the market might go up or why it might go down. Biggest risk is a U.S. recession sometime in the next year or less, and if there is a recession, that would most likely indicate a pretty good sized sell-off. If there's a global recession, that would hurt U.S. equities. Another big issue would be a trade war / tariffs. Right now, everyone's hoping that we come to a trade deal with China, or at least maybe there's a stalemate based on what it currently is. But if things were to get worse, the 2020 election, as we get closer and closer, and you have the threat of candidates that would be considered more extreme on the left side from the Democratic Party, those are things that might scare the market. Nobody is expecting inflation to get higher, but what if it does? What if there's an inflation surprise? What if there's some kind of supply shock? If inflation breaks out, those are things that would hurt the market. The bond market has completely ignored the problem of an exploding U.S. deficit, and maybe they won't pay attention to it for the next year or 5 years or 10 years, but at some point the markets will pay attention to that, and that's going to be a problem for the United States. The reasons why markets will go up, and this is what has been helping the market over the last several weeks and few months, is the Fed. A dovish Fed cutting back on the unwind of the balance sheet, which is going to happen soon. So those are all reasons why the market has gone up and might continue to go up. Plus $13 trillion, which is now a record number of sovereign debt yielding less than zero, and $26 trillion of bonds yielding less than the inflation rate. People are going to want to go into alternative investments, including equities, most likely equities. If the economic indicators, which have been slow to slightly turning to the negative, indicating a future recession, if they begin to turn positive, that of course would potentially help the market. For the market to continue to go up, you're going to need interest rates and inflation to stay under control, and hopefully for the trade wars and tariff situation to stay at least where it is and not get any worse, and no major mishaps in Washington. Of course, the big thing as being an investor is you want to be a long-term investor that has paid off traditionally in the United States. And here you see how GDP has really gone up pretty much consistently. And you see a few blips here, like in 2008, 2009. But over the long run, the United States economy has been a winner, which has led to a much higher stock market over time. There are lots of ups and downs. There are periods when the market can go sideways for a long period of time, and you'll have huge sell-offs along the way. But as a long-term investor, equities have been a good place to be. Anyway, that's our comments for July of 2019. We do write a weekly newsletter. Contact us if you'd like to be added to the list. And if you have any questions or want to discuss any of this, please feel free to reach out to any of us. Thank you very much and have a great day.